Hello guys, welcome to another video. In this video, we are going to talk about income statement under absorption costing. Actually, this is going to be a fourth video on absorption costing. In the first video, we talked about how to calculate the product cost by using absorption costing. In the second video, we talked about should we use plant-wide overhead recovery rate or departmental overhead recovery rate. And in the third video, we talked about how to calculate the under or over applied or absorption of overhead. And this is the fourth video, and we are going to talk about how to prepare the income statement by using absorption costing. So guys, if you remember from the last or from the previous videos, so when we calculate the cost of the product, I mean say product cost by using absorption costing, so what we need to include, we need to include the cost of direct material plus cost of direct labor plus cost of variable production overhead plus cost of fixed production overhead. Now guys, for the absorption costing, it is not necessary to differentiate the variable overhead and fixed overhead, because we can even club these overheads and we can calculate the one recovery rate. And if you remember, how we will calculate the recovery rate for the overhead, guys, because overheads are always absorbed based on recovery rate. So overhead recovery rate, which is also called overhead absorption rate, it is always equal to total estimated overhead cost divided by total estimated activity level. Okay, so mostly there are three most commonly used activity levels are there. We can use labor hours also to absorb the overhead. If our work is labor intensive, we can use machine hours also to absorb the overhead. If our work is machine intensive, we can use units of output also, or we can use any other basis which is given in that question. Okay guys, so then once, for example, if recovery rate is, let's assume $2 for each labor hour, let's assume. So when we record the overhead cost into the product, we always need actual activity level, because here activity level is labor hours. So you need actual labor hours multiplied by overhead recovery rate for each labor hour. This is how we absorb the overhead cost into the product. Okay, because this overview was important to understand the income statement. So here we go guys. So let's start how to prepare the income statement. So guys, first of all, when you want to prepare the income statement, so here we are maintaining two columns for amounts. One is inner and second is final column. In final column, we will show the final amounts of certain working. So here we go. First item which we need to record, that is called sales, because income statement starts with the sale, guys. So for the sale, how you will calculate the sale value? You always need unit sold times sale price of each unit. Once you will multiply, so you will get the value of sale, which you will write into the final column. From there, you have to subtract what? You have to subtract the cost of goods sold. And under absorption costing, cost of goods sold will include four components. So first component is opening inventory, second component is production cost, third component is closing inventory, and the fourth component is going to be the under and over absorption of overhead. So let's have a look guys how we will calculate. So it's just a format. After the format discussion, I will, of course, I will practice one question, long question with you to make it more clear. So guys, starting with the cost of goods sold, the first component under cost of goods sold is your opening inventory. And I'm assuming here opening inventory value is given. If it will not be given, the way which we will use to calculate the value of closing inventory, same way you can use to calculate the value of opening inventory, but only we will use the data from the last year. The reason is that this opening inventory is coming from last year or from the last quarter. Okay, it depends, you are preparing quarterly income statement or annual income statement. So guys, here we have an opening inventory. So far we are assuming it is given. It is given. So then you have to add here production cost. We have to add full production cost. And guys, full production cost might include, and it includes, by the way, two types of cost: variable production cost and fixed production cost. So here we are treating separately. So guys, variable production cost will include cost of direct material, direct labor, and variable overhead. Now the point is that how to write the variable cost into the product first. So guys, there are two scenarios now. Maybe when you will tackle the question, so examiner might give you cost of direct material. I mean, so these costs he might give you in terms of total cost, or he might give you in terms of per unit. For example, if in terms of total, if you are provided with the total data, for example, he told you direct material cost is $10,000, direct labor cost is $20,000, and direct variable overhead cost is, for example, $30,000. So total cost is $60,000. So guys, when you want to write variable production cost, so simply you will take this 60,000 and you will place in front of variable cost. But sometime he might give you, I'm going to explain second scenario now. He might give you data in per unit terms. So maybe he can tell you in simple words, variable cost per unit, variable production cost per unit. For example, per unit variable production cost is $5. So if this is the scenario, so then variable cost, how you will calculate? We need actual units produced, actual unit produced times variable cost per unit. Variable cost per unit is this 5, and actual unit produced, he will tell you in the question. Once you will multiply, you will again get the variable cost. Now let's move to the fixed cost. Guys, here I'm talking about the second portion of the production cost, which is called your fixed production cost. Again here guys, because fixed production cost, as we studied previously, we always need overhead recovery rate for fixed overhead. And how you calculate the overhead recovery rate? You need total estimated fixed overhead divided by total estimated activity level. Again, which activity level? Labor hours, machine hours, or unit produced. Okay guys, so any base will be given. So if we are taking here, you have to check overhead recovery rate. If overhead recovery rate is given in per unit terms, in per unit, for example, he told you recovery rate per unit is $3. So in that scenario, how can we calculate the fixed production cost? We need actual unit produced times fixed cost per unit, which is also called overhead recovery rate per unit. Once you will multiply, you will get fixed cost. But if he told you overhead recovery rate per hour mean to say maybe per labor hour or per machine hour, in that scenario, what you have to do? You have to take actual hours worked time what overhead recovery rate per hour. So you will get what here? Fixed cost. Okay, you have to remember all these scenario, please. Okay guys, now here, if you remember here, I'm using here actual activity level, either units, either hours times recovery rate. Okay, times recovery rate. So if you are following this format, so this answer, which is we have calculated here, this is called absorbed overhead. Absorbed overhead, like what overhead you have applied to the product. Okay, and which this is showing in the income statement now. So now guys, the third. So guys, here now I'm going to talk about how to calculate the value of closing inventory. So for the closing inventory, always you need what? You need unsold units first, because closing inventory, like these are those units which are not yet sold. You need unsold units, and we will multiply with what? With the product cost. So first question is that how you will calculate the unsold unit if it is not given. So it's very simple idea guys. If you want to calculate unsold unit, so this equation you can follow. You can take beginning units, okay, or opening units, whatever you have, plus units produced, how many units you have produced during the period. So from there, because if you will take beginning plus unit produced, it's also called units available for sale. From units available for sale, if you will subtract what? Units sold, like units which you have sold during the period, so you will automatically get what? Unsold, or which is also called ending inventory units. Okay guys, so I need unsold units times what? Product cost. Now the point is that what is the product cost? Product cost means, if you look at here in the production cost, we have a two types, variable and fixed. If you will take variable cost per unit plus fixed cost per unit, if you will add these two costs, this is called your product cost under absorption costing. Product cost under absorption costing. So this product cost, you will bring it here. You will just multiply with the unsold unit. So you will get what? value of closing inventory, which you will minus from the cost of goods sold. Now guys, we have here fourth item, which is going to be the part of cost of goods sold. This is called what? Under or over absorption of overhead. So here you can see here working to how you will get under or over absorption. By the way, I have already uploaded a video for under and over absorption, but here I can just quickly repeat here in simple words what is under and over, how you will calculate. So here we have a working to. Let's move to the working to, how you will calculate this value. So guys, here we have a working to how to calculate under or over absorption of overhead. And this under and over absorption of overhead adjustment is required at the end of the year, because when we prepare in the income statement, we have to record actual fixed overhead cost in the income statement actually. But there practically in income statement, absorbed fixed overhead is showing there, but we have to record what? Actual. But what is showing? Absorbed. So the difference of actual and absorbed, we will adjust, because we want to bring the absorbed overhead to the actual overhead. So by adjusting under and over. So how you will calculate it, guys? So if you want to calculate under and over absorption of overhead, so here we have a simply format. So what we need to do, we will take total actual fixed overhead cost, which will be given in the question. Actual cost, for example, 120,000. You will compare actual fixed cost with the total absorbed or applied overhead. Okay, absorbed and applied, how you will calculate, guys? It depends on your recovery rate. If recovery rate is per hour, per labor hours or per machine hours, so that you will multiply with the total actual labor hours or machine hours. If your recovery rate is per unit already, so here you should multiply with the total actual unit produced. Okay, because it depends. So of course, if recovery rate is per labor hour, so you will multiply with total actual labor hours to get the absorbed. Okay, actual labor hours. If recovery rate is per machine hours, so you will multiply with total actual machine hours. Okay, if recovery rate is per unit, so you will multiply total actual units to get the absorbed. So I'm assuming here just assumed value because I'm discussing format. So let's assume our recovery rate is $5.26 per labor hours, and our total labor hours are 19,000. If you will multiply, so you will get what? You will get the applied overhead. Now you will check. See, you have to check now your applied overheads are less than actual, because this is the value which have already reflected in the balance sheet, but this should have been reflected there. Actual should have been reflected there, but this is already is reflected there. So what you have to do? So you have to take the difference, because absorbed overheads are less than actual. So that is why it's called under. So what you will do? You will take this 20,000, because this 100,000 which is absorbed is already showing in the income statement. So you will add there 20,000 which is called under absorbed. So you will automatically reach to 120,000, so which is equal to your actual overhead. So that is why whenever your absorbed overhead, I mean say applied overheads, are less than actual overhead, this is called under absorbed, and under absorbed overhead we will add in cost of goods sold. I'm assuming amount of the difference is immaterial. If applied overhead, I mean to say this value applied is greater than actual, so in that scenario it is called over absorbed. So in case of over absorbed, we will deduct from the cost of goods sold. Okay, so this value actually, guys, the difference of actual and applied, under and over, you will take it there. So under applied you will always add in the income statement. Okay, why we are adding under applied in the fixed cost? The reason is that our absorbed overheads are less, but actual are more. So that is why you want to reach to the actual. So under you need to add, and over you will always subtract, because absorbed are more and actual is less, and you want to move from higher to lower value. So that is why over absorbed you will minus. Okay, so once you will adjust these four items, which four items, guys? Opening inventory plus production cost, opening inventory plus production cost less closing inventory plus minus under and over absorption. If you will add these four values, so this is going to be your what? This is going to be your cost of goods sold. Okay, guys, so this is going to be your cost of goods sold. So what you are going to do? So this cost of goods sold, you will take it to the final column, and on the top we have already value of sale, this value of sale. If from the sale you will subtract cost of goods sold, so what you will get? You will get gross profit. This is called your gross profit. Okay, guys. So from the gross profit, you have to subtract now all non-production cost. Non-production cost might include selling cost, marketing cost, administration cost. If you will subtract all cost, regardless those costs are variable or fixed, if you will subtract all cost from the gross profit, okay, so you will get what? Operating income. Okay, this is how to prepare the income statement by using absorption costing. Okay, guys, so here now let's have a look. Let's practice through the help of question. So guys, here we have a question to practice. Let's read the question first, and then we will apply, and I will show you through a step-by-step calculation now, because previously just we discussed the format. So here we have a following example will be used to understand this. What is the example we have here, guys? Big Wolf company manufactures a single product. We are manufacturing single product, the bark, details of which are as follow. We have here per unit data. We have here selling price per unit is $180. We have a direct material cost per unit $40. We have direct labor cost of $16. We have variable overhead of $10. And guys, here we have a data for the fixed cost also. Annual fixed production overheads are budgeted to be 1.6 million. Okay, and Big Wolf expects to produce 1.28 million units of the bark each year. Okay, so this is expected unit. This is your expected cost. It means recovery rate you can calculate. Okay, we will see how to do it. Overheads are absorbed on per unit basis. Actual, like here overheads you are charging based on number of units. Actual overheads are 1.6 million. Okay, budget was also 1.6, actual is 1.6 also. So it doesn't mean there is no under and over absorption. No. Okay, there could be under and over absorption. We will see. Then guys, here we have here budgeted fixed selling cost are 320,000 per quarter. This is quarterly data. And if you look at here, this is, I guess, annual data. This data is annual. Okay, this data is annual. But here we have a quarterly data. Actual sales and production units for the first quarter of 20x8 are given below. So we have here sales data. We have a from first quarter January till March. We have a sales of 240,000 units. We have a production of 280,000 units. And there is no opening inventory at the beginning of the January. Prepare the income statement by using the absorption costing. How it is going to work, guys? So let's do in step by step. So it's easy, don't you worry. So here we go, guys. So this is how you will you can find the step. So step number one, what we have to do, we can calculate the overhead absorption rate per unit. And don't worry, don't forget, we are talking about here only fixed overhead cost. Okay, fixed overhead. So we are going to calculate overhead recovery rate for the fixed overhead. And how you will calculate overhead absorption rate or recovery rate. So this is always the formula which we will use. And recovery rate we always calculate at the start of the year. And what is the formula? Fixed, budgeted fixed overhead divided by budgeted units, because overheads are absorbed based on units. Now guys, you have to check here. Also be careful with your calculation here, because you are dealing with 3 months period data, like quarterly data, but the figures in the questions are for whole year. Yearly data is given. So that is why first what we have to do, we have to convert those annual amounts to the quarterly figures. We have to adjust first. Okay, if you will remember, the budgeted overhead cost is given in the question as 1.6 million budgeted fixed overhead cost. So if you want to convert it to quarter, so we have a 4 quarters in a year, so you will divide with the 4 quarters, so you will get quarterly fixed cost, which is 400,000. This is we need because we are dealing with the quarterly data. Then guys, we have here production units, budgeted production units. It is also given in annual terms, 1.28 million units. It's given in the question. You will divide with the 4 quarters in a year, so you will get per quarter units, which is 320,000 units. And now you can calculate overhead recovery rate for the quarter. And what is the formula? We need quarterly budgeted overhead, which is 400,000, this value, divided by budgeted units, which is 320,000. So our rate, overhead recovery rate, is $1.25 per unit. So this is what we have just calculated, fixed cost. Okay, now guys, here what we have here now, second step. What second step we will do? We will calculate the total cost per unit. Cost per unit, total cost. In total cost we have variable cost of the production plus fixed cost of the production. And fixed cost per unit, we have calculated 1.25. This is the per unit. And now you have to check the variable cost. If you will just go back to the question, variable cost is, we will go back to the question here. We have a variable cost. We have a direct material, direct labor, and variable overhead. So it is going to be total cost. So if you will take variable, we have a direct material of 40 plus direct labor of 60 plus variable overhead 10 plus fixed overhead is 1.25. So your product cost under absorption costing is $67.25. So we got the cost per unit also. Now very easily we can also calculate the value of closing inventory. And how to calculate the value of closing inventory? First we need to calculate the units in closing inventory. And the equation is very simple. Closing inventory units is always equal to opening inventory units, which is 0 in the question, plus production is 280,000 units, he told you in the question, minus sale, and sale is 240,000 units, he also told you in the question. So just confirm from the question. So here we have it, guys. We have here sale of 240, production of 280, and we have opening inventory is 0. He told you 0. So if you will solve this equation like opening plus production minus sale, you will get unsold units, and unsold units are 40,000 units. If you will solve this, you will get 40,000 units. These are units. Now we can convert to the inventory value also. Very simple. We will take this units unsold multiplied by product cost. This will give you value of closing inventory which we need for the income statement. Okay, because simply you need unsold unit times product cost. Okay guys, so then what we have here, fourth calculation we are doing here. This is another way to do under and over absorption of overhead. It's a shortcut way. So guys, under and over, how you can see here, just simply compare the actual production with the budgeted production. Your actual production is given 280,000 units. Budgeted production was 320,000 units, because we have annual production 128 something like that. We divide with the 4 there, right? 1.28 million. So you got this budgeted production 320,000. You can see here your budgeted production was more, actual is less. So that is why it's called under production, because actual is less now. So actual production is less. Okay. So guys, you have here under production of 40,000 units. So now this 40,000 unit, if you will multiply with the fixed cost per unit, which is 1.25, okay, so you will automatically get under applied of overhead, which is 50,000. Okay, it's an under absorption because your actual production is less. Okay, guys. So then what to do? This is the simplest way to do it. Okay, guys. So then we have here what we can produce the income statement. We can produce the income statement here. Okay, so income statement. How you can produce the income statement now? It's very simple, guys. We are using absorption costing. Okay, so we will write the value of sale, and how you will get the sale. Your actual sale is 240,000 units. It's given in the question, and actual sale price is $180. It's also given in the question. Just go back. You can check it there. So you will get the value of sale. Then from the sale, you have to subtract what? You have to subtract cost of sale. You have to subtract cost of sale, and cost of goods sold. I told you it will include 4 things: opening inventory plus production cost less closing inventory plus minus under and over absorption. So opening inventory value is 0. Second, we have here production cost. Production cost, how you can take, you need units produced, which is 280,000 units. It's given in the question. Okay, it's given in the question. You can just check it there in the question. 280,000 units we have here. Production 280,000 units here. Okay, 280,000 units multiplied by product cost, and product cost just we calculated here 67.25, because it includes variable cost plus fixed cost. Variable cost plus fixed cost, and just we have calculated here product cost here, just 67.25 here, this value. Okay, 67.25. This is your product cost. So simply you will take what? Unit produced time product cost, because it includes already variable and fixed, both it's there. So you will get the production cost, less you have to subtract closing inventory value. So you need unsold unit, which was 40,000, just we did it above now. Okay, so times what? Product cost again. So this will give you closing inventory value. Then you have to plus or minus under and over absorption of overhead, and under and over absorption of overhead, just we got it there. There is under absorption of 50,000 in step number 4. If you will just go back here, step number 4, we have here 50,000 under absorption. Okay. Then this is what, if you will add plus minus these 4 points, opening plus production, less closing inventory, plus minus under and over absorption, what you will get? You will get cost of goods sold. From sale, if you will subtract cost of goods sold, you will get your gross profit. Okay, you will get your gross profit. From the gross profit, you have to subtract all non-production cost. And by the way, we have only fixed selling cost as a non-production cost in the question as a $320. So this is how you will get net income or operating income, because we don't have anything other interest and etc. So guys, this is how you will prepare the income statement by using absorption costing. So in the next video, what I'm going to do, I'm going to compare variable costing with the absorption costing. I mean, say marginal costing with the absorption costing, and we will see what is the main differences after this detailed discussion. So we are going to just summarize in the next video, and then I will talk about profit reconciliation under both method. Thank you so much, guys. See you next time. Bye bye.